Welcome back to the Deep Dive. We've got a really interesting one lined up for you today. We're going to be diving into the mind of Bill Gross.
The Bond King.
That's right. We're talking about the man himself. And what we're going to be looking at is over 40 years of his monthly investment outlooks, going all the way back to 1979.
Yeah, he's been at it a while.
He has. So we've got a lot of material to cover, and I'm really excited about this one because it's not every day you get to trace the thoughts and the predictions, really, of someone like Bill Gross over such a long period of time.
Absolutely. And these investment outlooks, they weren't just your typical, dry market analysis.
No.
He really brought in a lot of personality. You get his insights into the economy, but then he's also weaving in personal stories, pop culture references.
He even throws in some humor along the way, which, for me, always makes these things more interesting to read.
Absolutely. He understood that, to really connect with investors, you have to engage on a human level. It's not just about the numbers. It's about the story behind them. It's about why it matters to you and your portfolio.
I think that's what makes for a compelling market commentator, don't you?
Yeah.
Someone who can not only read the numbers, crunch the data, but also make it relatable, make it interesting.
Definitely. Anyone can tell you what the market did today. But to really understand where it's going, you need someone who can connect the dots, see the bigger picture. And Gross was a master of that.
Yeah, he really was. So to kick things off, let's rewind the clock a little bit. We're talking late 70s, early 80s, the backdrop for Gross's early years in the market. High inflation, interest rates all over the place. It was a very different economic landscape than what we're used to now.
Right, it was a volatile time.
So what was he focused on back then? What were some of his key themes?
Well, one of the things that really stood out to me, even in his early writing, is his focus on demographics.
Oh yeah, he talked about that a lot.
Yeah, especially the baby boomer generation. He saw early on how this massive demographic wave would impact, well, pretty much everything. Spending habits, savings rates, the housing market.
Long-term economic trends.
Exactly. He was a big believer that demographics are destiny.
And he had this whole plankton theory that he talked about. Have you heard of this?
Oh yeah, the plankton theory. It's classic Gross, and it's a great way to understand his thinking.
Okay, so for those who haven't heard of it, what's the plankton theory all about?
Well, think about plankton. They're tiny, right? But they're the base of the entire ocean's food chain. Everything else depends on them.
Right, it all starts with plankton.
Exactly. And Gross's point was that just like plankton support all life above them, these big demographic shifts, like the rise of the boomers, are what drive long-term economic growth. He was looking beyond the day-to-day market noise and trying to grasp those bigger generational tides.
So he's thinking long-term, big picture.
Yeah.
But he also weighed in on that age-old debate. Stocks versus bonds.
He did. And he wasn't afraid to challenge conventional wisdom.
What was his take?
Well, he looked at historical data, of course, but he always emphasized that there's no one-size-fits-all answer. A lot depends on your individual time horizon, your risk tolerance.
Right, how long you're planning to invest, how much risk you're comfortable with.
Exactly. He wanted investors to think for themselves, understand their own circumstances before jumping into any one asset class.
Which is always good advice. Now let's fast forward a bit. As we move into the 80s and 90s, there's a noticeable shift in Gross's writing style.
Oh yeah. It's subtle at first.
But it becomes more and more apparent. He starts to inject more humor, more personal anecdotes, pop culture references.
Right. He even starts using these little phrases like "gag me with a spoon."
Chuckles.
Yeah.
He did. So why the change? What do you think was behind this evolution in his writing?
Well, I think it mirrored the changing financial landscape. Deregulation, new investment products, increased competition. The whole industry was becoming more dynamic, less formal.
Kind of like Wall Street was loosening its tie a little bit.
Exactly. And Gross's writing reflected that. His November 1982 outlook, Valley Talk, is a great example of this. He invents these characters.
Valley guys.
Yeah. The Valley guys. He uses them to poke fun at all the latest financial trends, the jargon. It's hilarious.
Give us a taste. Any specific anecdotes from Valley Talk that really stand out?
Oh, there are so many. But one that always cracks me up is when he's describing different Valley investment philosophies.
Okay, I'm ready.
One of them is called Bottoms Up, and he writes, "Invented after 3 beers at Casey's Bar in the Galleria."
Only Bill Gross could come up with that.
Right. And then he goes on, "Mocks those that purport to forecast the economy but claims omnipotence in forecasting individual earnings and industry trends."
Okay, that's brilliant. Gag me with a spoon.
He really nails it. And that's it. He's making you laugh, but he's also making you think.
It's not just entertainment. There's real insight there.
Absolutely. And this is when he starts gaining recognition as an investment guru. People are drawn to his wit, his ability to break down complex ideas in a way that really resonates.
He's not talking down to people, but he's not talking over their heads either. He's meeting them where they are.
Exactly.
And all while this is happening, he's also developing his own investment philosophy, right? I mean, he starts talking about things like selling volatility and the importance of understanding the difference between cyclical and secular market trends. What did he mean by all that? And maybe more importantly, how is that relevant to someone listening right now?
Okay, so selling volatility can get a bit technical.
Yeah, we don't have to get too deep in the weeds on that one.
But the basic idea is that you're using strategies that profit when markets are relatively calm and predictable. You're basically selling insurance against big market swings.
Interesting. So kind of like betting on stability.
In a way, yes. But as for those trends, cyclical versus secular, that's something everyone should understand. Think of cyclical, like the ebb and flow of the tides. They're short-term ups and downs, influenced by things like economic cycles, interest rate changes.
Okay, those make sense. What about secular?
Secular trends are more like the long-term direction of the ocean current, those deeper forces that play out over years or even decades.
So things like demographics would be a secular trend.
Exactly. Or technological innovations, shifts in global power dynamics. Those are all secular trends.
So what you're saying is that he was trying to encourage investors to look beyond those daily ups and downs, the short-term noise of the market, and focus on identifying those bigger underlying currents driving the market.
Exactly. He believed that understanding those secular trends was crucial for long-term investment success.
That makes sense. It's like if you're trying to sail across the ocean, you need to know which way the wind is blowing, but you also need to understand the currents.
Right. You need both.
Now, let's talk about the late 90s, the dot-com boom. Everyone was caught up in this new age economy. The internet was going to change everything. But Gross, not so much. He was skeptical, wasn't he?
He was one of the few voices urging caution amidst all the euphoria.
Yeah, he was sounding the alarm bells pretty loudly, as I recall.
He saw what was happening, the excessive speculation, those sky-high valuations that were completely detached from any kind of fundamental analysis.
It was a classic bubble, looking back on it.
It really was. And he was concerned about the long-term implications, even if everyone else thought the party would never end.
Which, of course, it did.
Yeah.
But even back then, what were some of the potential downsides of the internet that Gross was highlighting? Because obviously the internet did change everything.
Oh, absolutely. And he wasn't saying the internet wasn't a big deal, but he saw a lot of hype, a something-for-nothing mentality. He even called it a short-term investment phenomenon.
Oh yeah, he did say that.
He was worried about the potential for increased global competition, the impact on corporate profits despite the potential for growth. He even introduced this idea he called the Amazon.com theory in his September 2000 Outlook.
Amazon.com theory. Now that's intriguing. What was that all about, and what did it mean for investors, particularly those holding bonds?
Well, he used Amazon as an example of the risks in blindly chasing high-growth tech companies, especially for bondholders.
Because bondholders are typically looking for a different kind of return, right?
Yeah.
A little more stability, a little less risk.
Exactly. And his point was that while stock investors can diversify their bets, hoping that a few big winners will offset the inevitable losers.
Bondholders don't have that luxury.
Exactly. If a company goes bankrupt, its bonds are worthless.
No matter how high the stock price might have been.
Exactly. So he was really emphasizing the importance of downside protection, especially for bond investors who weren't looking for those super high growth, high risk returns.
So he's going against the grain here, right? Most people are euphoric about the internet, and he's urging caution.
He was. And as we know now, his skepticism about the dot-com bubble was spot on.
And he was right to be skeptical, because when that bubble burst, it wasn't pretty.
No, it wasn't a pretty sight.
So as we head into the 2000s, kind of a new millennium, a new era, what's on Gross's mind? What themes are popping up in his outlooks as we enter this new decade?
Well, he starts to sound the alarm about a few things that he'd been hinting at before, but now they're really coming to the forefront.
Like what?
Excessive debt, for one.
Oh yeah, that becomes a big one for him.
The rise of China and the possibility, even the likelihood, in his view, of deflation.
Deflation, that's interesting. And we're going to come back to that because I think that's a really important concept that a lot of people maybe don't fully grasp. But first, let's talk about debt. He saw some parallels to past economic crises, didn't he? I mean, every time you have a big financial crisis, it seems like debt plays a role.
Yeah, for sure. He often compared excessive leverage, whether it's personal debt, corporate debt, government debt, to pouring gasoline on a fire.
Ooh, that's a scary image.
It magnifies both gains and losses, right? So when things are good, debt can make them seem even better. But when things turn sour...
Look out.
Exactly. And he was very critical, I think rightfully so, of how reliant the U.S. government was becoming on foreign investment to finance its growing deficits. He didn't see that as a sustainable path.
So he's really connecting the dots here. It's not just about individual consumers taking on too much debt. It's about the whole system.
Exactly.
And at the same time that he's talking about this growing debt bubble, he's also talking about the rise of China. How did he view China's emergence as this economic powerhouse? Because it was really starting to take off during this period.
He had a nuanced view, which I always appreciated. He saw both the opportunities and the challenges. He recognized that China was becoming the world's factory, producing goods at a lower cost than anyone else, and that this was having a huge impact on global trade. But he was also wary of its potential to contribute to global deflation, which brings us back to your earlier point.
Okay, so let's talk about deflation. Because I think a lot of people, when they hear that word, they think, well, isn't that a good thing? Lower prices, that means I can buy more stuff. But Gross was concerned about deflation. Why?
Because he understood that while lower prices might sound appealing in the short term, deflation can actually be really bad for economies in the long run.
How so?
Well, if people expect prices to keep falling, they might hold off on making purchases, thinking they can get a better deal later. Businesses might postpone investments for the same reason.
So it kind of creates this downward spiral.
Exactly. Reduced demand leads to lower prices, which leads to even less demand. And this can lead to job losses, wage cuts. It becomes a really vicious cycle. And he was especially worried about deflation in a world that was already drowning in debt.
Because if your income is shrinking and prices are falling, your debt doesn't shrink, does it?
No, it doesn't. In fact, it becomes a bigger burden because now your income is worth less relative to what you owe.
That's a really important point. And this is where Gross's foresight really shines through, because he was talking about these things, debt, deflation, long before they became mainstream concerns.
He was ahead of the curve on a lot of these issues.
He was. Now, I want to talk about how he advised investors to navigate these choppy waters.
Right, because he wasn't just a doom and gloom guy, right? He always had practical advice.
Exactly. So what kind of investment approach was he advocating during this time with all these risks on the horizon?
He became a big proponent of a phrase that you hear a lot in investing: don't fight the Fed.
Don't fight the Fed. What does that mean exactly?
It means basically that the Federal Reserve, the central bank of the United States, has immense power to influence the economy through its monetary policy decisions.
Right. They control interest rates, they control the money supply.
Exactly. And Gross's point was that trying to outsmart the Fed is usually a losing game.
It's like trying to fight a rip current.
Exactly. It's not going to end well. So he said, instead of fighting the Fed, understand what they're doing, why they're doing it, and align your investment strategy accordingly.
So it's not just about picking the right stocks or bonds. It's about understanding the bigger picture of monetary policy.
Exactly. He was all about context.
He was. And I think that's such an important lesson for investors to remember, even today. Because it's easy to get caught up in the day-to-day market noise and forget about those bigger forces that are shaping the investment landscape.
For sure.
Now, besides don't fight the Fed, what other timeless principles did Gross emphasize?
Well, he always stressed the difference between nominal returns and real returns.
Oh, right. That's a good one.
Nominal returns are what you see on your investment statement, but real returns take into account the erosion of purchasing power caused by inflation.
Right. If your investments are going up by 5%, but inflation is running at 3%, you're only really making 2%.
Exactly. And that's crucial to understand, especially in today's environment where inflation is higher than it's been in decades.
Absolutely. What else?
He was always wary of excessive leverage, as we discussed earlier.
Yeah, never a good idea to have more debt than you can handle.
And he loved the saying, history doesn't repeat, but it rhymes.
Ah, yes. A classic. What did he mean by that?
He meant that while we should never expect the future to be a carbon copy of the past, there are often patterns and cycles in financial markets that we can learn from. By studying history, he believed we could gain valuable insights into how markets might behave in the future.
So it's about recognizing those patterns, those rhymes, and using them to inform your investment decisions.
Exactly.
Great advice. Now, as if debt and deflation and the rise of China weren't enough to worry about, the world gets another jolt in the late 2000s, the global financial crisis. This was a real shakeup of the system, something that nobody really saw coming.
A real black swan event, as they say.
Exactly. So what was going through Gross's mind as this crisis played out? Because he had been warning about some of these very things, hadn't he? The excessive debt, the leverage, the speculation.
He had, and in a way, I think he saw this crisis as a culmination of a lot of the trends he'd been highlighting for years.
A validation of sorts.
In some ways, yes. He had been saying that the system was built on shaky ground, and now the ground was giving way.
Right. But he wasn't just dwelling on the past, he was also trying to make sense of what this crisis meant for the future, right?
Exactly. He was always looking ahead, trying to anticipate what was coming next.
So what was his outlook? What did he see as the path forward after this massive financial earthquake? So much uncertainty, right? After the financial crisis, it felt like the whole world was trying to figure out what comes next. What was Gross's take? What kind of future did he see emerging from all that chaos?
Well, he had this phrase, he called it the new normal.
The new normal. I remember that. What did he mean by that?
He believed that the world had fundamentally changed. This wasn't just a blip on the radar, a temporary setback. He saw a future of slower economic growth, lower investment returns.
And more volatility?
Exactly. More frequent booms and busts, more uncertainty overall.
So a world where the old rules no longer apply.
In a lot of ways, yes. And this was a challenging idea for a lot of people to accept, especially those who had grown accustomed to decades of relatively predictable growth.
Right, it's hard to let go of those old assumptions. So in this new normal, how did he think investors should approach the market? What was his advice?
He started urging a much more cautious approach, even a defensive approach. Preserving capital became paramount, avoiding those big risks that might have been acceptable in the past, and focusing on high-quality assets that could weather the storm.
So kind of like battening down the hatches.
Exactly. In a hurricane, your priority shifts from, maximizing your profits to just making sure your house is still standing afterwards.
Right, survival first.
Yeah.
But Gross was never one to just sit on the sidelines, was he? Even in this new normal, he was still looking for opportunities.
Oh, absolutely. He was always thinking 3 steps ahead, trying to anticipate where the puck was going, not where it had been.
So where was he seeing potential in this new landscape?
Well, he was drawn to things like inflation-protected securities.
TPS, as they're known.
Right, TPS. Because he was concerned about inflation eroding returns, even if it wasn't showing up in a big way yet. He saw TPS as a way to hedge against that risk.
Makes sense. What else?
He was also exploring emerging markets because, as he saw the global economic landscape shifting, he knew that new centers of growth would emerge.
So not just looking at the US or Europe anymore.
Right, expanding the scope.
Always adapting, always evolving. And this ties into his idea of structural alpha, right? Something you mentioned earlier. Could you remind us again what he meant by that and how it fits into his approach during this time?
Yeah, so structural alpha, as Gross described it, was about identifying and exploiting those long-term structural shifts in the global economy.
Instead of just focusing on short-term market swings.
Right. So, for example, instead of trying to predict, what the stock market is going to do tomorrow or next week, he was more interested in understanding how demographics, technology, geopolitical shifts, how these bigger forces were likely to shape the world over the next decade or two.
So it's about spotting those underlying currents that are driving the market, rather than getting caught up in the waves on the surface.
Exactly. And he believed that this kind of approach, which requires a lot of research and a deep understanding of history and global trends.
It's not for the faint of heart.
No, it's not. But he believed it was essential for generating consistent returns in a world that was becoming increasingly complex and unpredictable.
So, as we wrap up our deep dive into the mind of Bill Gross, the Bond King, what are some of the biggest takeaways you hope listeners will remember, especially as they navigate their own investment journeys?
Well, we could talk for hours about his specific predictions and strategies, but I think his real legacy is about something bigger than that. It's about the importance of independent thinking.
Which is something he did better than almost anyone.
Right. He was constantly questioning assumptions, challenging conventional wisdom.
And encouraging his readers to do the same.
Exactly. He wasn't afraid to go against the grain, to be the lone voice in the wilderness sometimes. And that's a really powerful lesson for anyone, whether you're managing a portfolio or just trying to make sense of the world around you.
Don't just accept things at face value.
Right. Think critically. Do your own research. Challenge your own biases.
And never stop learning.
Absolutely. The markets are always changing, but the principles of sound investing, thoughtful analysis, a healthy dose of skepticism, and a willingness to adapt those remain timeless.
Well said. And on that note, we're going to have to wrap things up, but this has been a fascinating conversation. Thanks for joining us on this deep dive into the mind of Bill Gross, the Bond King. Until next time, happy investing.